We're watching tech closely this morning as a sell-off in chips as the NASDAQ down near the lows, but they are buying the dip in small caps, at least trying to, with more than a percentage point move off the open. Joining us, John Kosar from Asbury Research, who's got 6 metrics he looks at within the market to try and determine direction. He does a pretty darn good job doing it. John, welcome back.
Good to be back.
I see a little red cropped up since our last chat. Let's talk about a couple days ago, one of your market metrics, which keys in on the VIX, actually turned red, and otherwise all your stuff has been positive for a good bit of time now.
It has. It's actually been positive since June the 25th, and outside of the reversal today, the S&P went up by another 4% since then, and it's generally been green really since the early part of November of last year.
Yep.
You know, barring a couple of wiggles here and there.
Yep.
It's a sensitive indicator. It's supposed to pick up these little nuances.
Yep, and that's where this stands out to me because the VIX is not particularly high, but we did kind of base out in VIX. We saw some stocks up, VIX up days. So what is it about volatility in your mind that has turned adverse?
Well, the Asbury 6 is based on a monthly change in all of these metrics. There's, the 6 metrics. So when the VIX is down that low and the ranges are that small, it doesn't take a whole lot to turn it, from red to green or green to red. So that's really what's happening here. Of the 6, there's the rate of change, I think, is getting relatively close to where it could turn red, but just 10 minutes before I was on with you, I just looked to see, were we close to turning any other Asbury 6 individual indicators down to red? And we're not really. So, we're down 62 so far this morning. Who knows? We could be up 62 by the end of the day, the way things go here. But right now, it would take more than just a bad day to turn the Asbury 6 to red, which would be 4 or more of the constituents turning red.
Okay. So one more thought on VIX and volatility here, since it's based on month-over-month change. Basically, it set off that alarm bell on yours because it went up from like sub 12 to basically 13ish or so over a month. That's a pretty low threshold, but it's interesting because we also, when we look at it through that lens, VIX has kind of been bottoming if you kind of go the illegal route of doing technical analysis on the VIX. I don't know, you might be onto something, John.
Well, again, that's why we have the Asbury 6, not the Asbury 2, right? We've got 6 really diverse indicators that are going to give us the luxury of throwing one out, so to speak, if it's out of line. But I mean, except for the the feeding frenzy that we've had really since the second week of January, it was right after, it was like January the 11th, January 10th. There was a big technology conference in Las Vegas that said a lot of very positive things about AI. That's when NVIDIA broke out, and we've had this crazy 6 months. But generally speaking, when you get the VIX around 12 in a normal market, which we're really not in one right now, oftentimes that leads into some kind of a peak. So I don't want to get overemphasize the VIX here, because frankly, with the other stuff that I'm looking at, it's really tertiary.
Okay.
But that's just something to look at when you're thinking about VIX.
Yeah, fair enough. Well, it's just interesting because it's the one thing that's kind of unique this morning is VIX is waking up basically, and it seems like it was creeping going into this with some of the kind of aggressive call buying happening. So, all right, it's interesting that that's one that flashes red. John, generally, how does this extreme rotation kind of factor into your approach? I mean, when you've got such an aggressive move in the small cap world, the value versus growth shift, what's kind of your overall top line takeaway from this past week?
Over the past couple of weeks, one of our models, it's called the CARP model. It shows the cross-asset relationship between 8 different equity relationships, like growth versus value, tech versus broad market, small versus large. we've been seeing some subtle shifts in there over the past couple of weeks that didn't indicate, but it just suggested that there was some internal changes going on. You even saw it in another model that we have. It looks at 25 global equity markets versus the US. You saw relative outperformance on a weekly and on a monthly basis over the past couple of weeks throughout most of those 25, which really pretty much encompass the whole world. So there have been very subtle indications on some of our more sensitive metrics that there was some internal churn going on. There was some internal change. The thing that's the most important to me right now that I'm watching is the relative performance between NDX and the S&P 500, which is the large cap tech, which is where all those big names are that have been dragging the market higher. And the second thing is relative performance versus the stocks. Semis and tech have been really leading the market higher for months and months. They're starting to roll over here. It's over the past couple of days. Again, it's nothing sea change, but if we lose semiconductors and we lose big cap tech as leaders, either the cavalry has to come in from somewhere else and rescue the market, or we're going to go into a correction.
100% love that assessment, because it just, to me, still seems like the sort of Occam's razor approach to figuring out what the market does when you've had such extreme leadership. We can go the macro route and do all the prognostication about elections and such, but it kind of just matters the most if chips break down or not, right?
Yep.
Hey, John, real quick. You've got some stuff on banks and financials, a couple charts. What are you watching for that sector? And real quickly.
Well, if we pull up my SEAF model graphic, two really interesting things there. One is financials showed up as a top 3 ranking there on
flows,
7-8.
right?
Yeah, this is the flows. There we go. So you see the top 3 there: financials, utilities, technology. Two real good takeaways here. Look at technology in the trading category. There's 3 different time frames here. We have trading and tactical and strategic. This is just 1 week. So there was a fire sale in technology last week. A lot of money came pouring out of there last week, which is kind of the precursor to what we're seeing this morning. Meanwhile, look at financials. It's got top rankings all the way here. So the model itself went overweight financials on 7-8. Since then, we've got 5% move higher in XLF, and it's outperformed the S&P by 5% during that same period. So I'm watching financials here. We're starting to see some breakouts in some different parts of the financial space, namely insurance, KIE. Oh, this is, so what we have here, this is XLF. This is part of the SEAF model. We call these rainbow charts, right, for obvious reasons. But you could see on July the 3rd, it moved into a favored status. In other words, there was aggressive asset flows moving in all 3 different time periods. And that July 3rd was the precursor to the 5% move higher that we've had in XLF since then, which is a pretty good move in just a week or so.
Yeah. I like your eyes on the insurance, too, with KIE. Look at the way flows have pivoted pretty well into a lot of these financial sectors. Pretty compelling stuff. And that top chart there kind of looks like it's a little bit of a breakout. John, we love the analysis. Appreciate your time, sir.
Good to see you. See you next time.
All right, absolutely. John Kosar, Chief Market Strategist at Asbury Research. All right, always fun going down from the top macro discussion into a couple sectors and themes, charts John likes.